50-year mortgages are on the horizon. Here are our thoughts and more. Stay tuned to this episode of The Den.
The Den, powered by the Lyons Group, a show that explores trending topics in real estate, entrepreneurship, and personal growth. We're a small team of professionals with over $400 million in sales and nearly 2,000 successful transactions. You're listening to time-tested experts and industry leaders. Here's a refreshing look at real estate happenings and more. Welcome to The Den.
Hey, everybody. Welcome to this episode of The Den. And today we're going to be talking about 50-year mortgages. They're on the horizon and it may be hitting our market. Is it a good thing or a bad thing? But before I get to that, let me introduce my friends, my partners, my co-hosts, the fellow members of the Lyons Group. To my right, Paul, Hand Me the Rock Berry. Aspen, the Ninja Gruen, is missing today. She's dealing with a flat tire up in Colorado.
2 weeks in a row.
2 weeks in a row. And we got the boss, Shannon Martinez. My name is Ben, debt service for the rest of my life on a 50-year mortgage Lyons, and I'm here to be your host today at The Den. So I know just saying a 50-year mortgage probably triggers some emotional response in all of us, but you have to kind of put that in check and really look at it through a few different lenses, and that's what we're going to talk about today. Is a 50-year mortgage a good thing, a bad thing? Maybe a mix of both. We'll see. Paul, what's your read on the 50-year mortgage? The thought of floating a 50-year mortgage has been put out in the market, and it may come to fruition. What's your initial thoughts?
So, well, I mean, really, they're all tools. There's thousands of different loan programs out there. This is just another one that does some good for some people. I mean, most people are in and out of their house by, there's some stats say 7 years, some say up to 13 years. That's the normal turnover for people in their homes. So nobody ever really, pays off a 30-year loan, pays off so 50 years is just to get them through those 13 years. And it's amortized, the same way as a 30 years. So the monthly payment's a little bit lower. Everybody's talking about the back end, but it's like, if the average is 13 years, even if it's 20 years, who cares about the back? You're not paying the extra $1 billion that they're talking about. And also, people are saying 50 years is way too long. I've sold houses to 80-year-olds that got 30-year mortgages. So
right,
that whole argument, I'll be dead by the time that's done. They'll still give it to you.
Right.
Well, it's
a tool.
It's a tool.
Not your, I didn't call
not
you
me. You're not talking to me here.
Not this time. Not this time. But it's just another tool that lenders have to help people get into a home.
Well, let's look at a real world example here, just for our audience to hear. Let's say you're going to purchase a home at $300,000 and you're going to put 20% down. So that's $60,000. So your loan amount would be $240,000. So in the current market right now, if you have a longer amortization, usually the interest rate goes up a bit. If you have a shorter, like a 15-year amortization, you typically get a better deal, a little bit lower interest rate. So in this example, a 50-year mortgage may be at 6.5%. A 30-year mortgage could be at 6%, and a 15-year mortgage could be at 5.5%. So what does that look like with a monthly payment? 50-year mortgage, you're looking at a total monthly payment of $1,275.
Principal and interest, right?
Principal and interest, not including taxes and insurance. Thank you for the clarification.
And we also have to disclose that this is not based on any facts. This is not for anyone. We are not lenders.
We are not lenders. And
it's not valid in California or Massachusetts.
Just comparing numbers.
That's just comparing numbers. A 30-year mortgage. So a 50-year mortgage, you're at $1,275 a month. A 30-year mortgage, which is what we're used to, is $1,439 a month. So you have a difference of about $175 or so. And then you have a 15-year note, which is at $1,938. So the difference between a 15-year and a 50-year is the difference of probably $325 a month in this scenario. Now, what really gets interesting is the interest paid. The total interest paid on a 50-year mortgage, assuming you carried it the full 50 years, would be $765,000 you would pay on that $240,000 note. And then on a 30-year note, if you carried it full term, it would be $518,000. And of course, on a 15-year, it's going to be significantly less, closer to $350,000. So the interest argument, and this is where a lot of people say, well, if you do a 50-year mortgage, what all you're doing is enslaving people to an interest payment for the rest of their lives. That's the big argument against a 50-year mortgage.
Go over the 30-year again. You're spending double on a 30-year, right?
Correct.
Mm-hmm. Yeah. I mean, we already have that.
Yeah. Yep. Now their argument is, and I'm not saying I agree, I'm just saying the argument is now it's worse. Now you're indentured to this debt for the rest of your years. And in fact, your very first payment, because the amortization is so long, your very first payment is negative. It's a negative amortization. In other words, you haven't even paid a penny toward principal. You are paying 100% interest, and you're actually negative. You have another $25 in this instance.
When do you get to principal? How long does it take?
That's a good question. I would say at least a year, maybe a year and a half.
There are programs out there right now that are so interest heavy or front loaded interest that it does take forever, or feels like forever, to get that principal reduction. So definitely, if the paid interest is of the most importance to you, look at the amortization schedule before you sign your loan.
Yeah. Great point. Shannon, I'm jumping over to you. What are your thoughts on a 50-year mortgage? Paul let us know it's a tool. He didn't call me a tool. He just said it's a tool. What are your
I won't
thoughts?
call you a tool.
Oh, thank you. That's two. I'm 2 for 2, people.
Today.
Happy Thanksgiving, by the way. I hope we all had a great Thanksgiving.
Yeah.
Yesterday was Thanksgiving, and we have a lot to be thankful for. And if you didn't watch our Thanksgiving episode, you should go back and watch it, because Shannon has an incredible recipe for the leftovers, which you should be eating today. So go.
You're gonna need it.
Yeah, go to last week's episode. Check out the comment section. We put in that recipe. I digress. But Shannon, back to you. 50-year mortgage.
Well, I agree. It is just a tool. I think that when people really get down in the weeds and get upset about this stuff, they're not looking at the biggest picture. It's like saying that a real estate contract isn't a good decision because you might pay higher interest rate, or you might have a balloon payment in 3 years that you can't afford. Nobody expects to pay the balloon payment in 3 years. They expect to refinance it before then, or figure out another option, sell the property that they're waiting on to sell, or whatever that is. I think that when people get really upset about these, is it right for everybody? No. Do I want one? No. But we grow, the biggest wealth that Americans have is in real estate, is in their home. And the idea is to get almost everybody buying into that wealth, everybody growing that wealth, everybody doing that. Now, if it doesn't make sense for the average person, because they say, look, I've been paying, the $1,200 a month rent now for the last 5 years, and I can do that, but this house that I need, this price point that I need to be at or can afford, this equal house for this rental is going to be that 14 or 15, I can't do that. Well, does it make sense? Sure, it makes sense, because what's going to happen over the next couple of years? Your needs are going to change. Your income's going to change. Your situation's going to change. That's right. You're going to start getting equity in that home. Even if you don't pay down a penny of your equity for a couple of years, if the market grows, you're still gaining some traction there. You're still gaining something. So by the time that you decide that this home no longer works for you and you sell it, now you're working with a nest egg to go to your next one. Buy more favorable terms on your mortgage, or get another 50-year mortgage. The idea that somebody is going to actually pay 50 years of the exact same payment on a house is almost absurd. I tried to look online. I tried to Google that, like how many actual 30-year mortgages get paid 360 payments. And it can't tell you, but it always says it's very unlikely. It's very low. There's no data on that. Because
no data on that. That's shocking.
Who does that? Nobody does that. Even if you say, I'm keeping this house for 30 years, this is my forever house, I'm going to retire in here, I'm going to fully pay it off, then you might want to get better terms, or get the best terms you can at the time. And then when terms are better, because during 30 years, it's always going to be better at some point, then you go out and you refinance, or you do something at a different rate. You figure out what works for you there. Switch over, you have a higher income, switch over to a 15-year mortgage, or just double your payments, If you can do the 15, do that, because you're going to get a lower interest rate. You're going to pay it off faster too.
I love the meme where they show Dave Ramsey on his deathbed and they're like, he just learned of a 50-year mortgage.
Right. Yeah.
Well, but I think too, like if you think about minimum wage, people are thinking like this 50-year mortgage, like you can't do that. Well, you can't live on a minimum wage either. These are entry-level mortgages. They're tools that,
That's
you know, if you're in a bad situation or this is the only thing that you can do, this is a good way to get into it, and you have options to get out.
Think of it that way. You're not buying it for 50 years. You know, you're using this 50-year mortgage to get in the game, to get going. There's how many people do we know, like I said, that do a real estate contract with a balloon payment of $500,000 in 3 years down the road? Are they going to have $500,000 in 3 years down the road? No, but they take it anyway because this tool works for them now. It procures that house, it gets them where they're going, and now they've got 3 years to either, like I said, sell another property if that's what they're doing, or find favorable terms that they're going to do. Whatever the situation is. Now, I'm not saying that you're guaranteed that situation is going to improve in 3 years, but chances are there's other tools within that time period for you to do that. So what is the problem with taking something that allows you a payment to purchase a house, to start investing, to start having your own place, building your own equity, and if in 5 years from now, you get out of it and you haven't gotten that far in it, that's okay. You might be in a better place to buy and you didn't rent for all those years. You actually had a home you could call your own.
Yeah.
Hi, I'm Ben Lyons, a partner at the Lyons Group. We're dedicated to making your real estate experience the best it can be. If you're looking to buy or sell, go to sjcbroker.com and watch our informational video series. These videos break down the process and shed some light on buying or selling. While you're there, schedule a private consultation with one of our partners. We'd love to sit down, talk strategy, and give you a real advantage in today's market. You deserve the best. So take those steps and we'll see you soon. Now back to the show.
Yep, and I've experienced that too, just on the loan side of like student loans. And I had a very small balance of student loans when I got out of college, but gosh, and I paid the minimum amount because that's all I could afford at the time. And it took years and years, and I didn't even start hacking into the principal at all. I mean, you could look at situations like that if you go out and you extend a line of credit on your credit card, or you do a cash advance or whatever. You're paying this exorbitant interest rate of 40%, 35%, 25%, and you just pay the minimum. It will take you decades to pay that off. And how much interest will you pay? So it's not like these things aren't out there already. They're already out there, and they're tools. For instance, what I would do was like, I'm going to charge up my credit card, and then I get my tax return in February or March, and I'm going to pay off the balance, right? So that's a tool that I would use when I was younger. I didn't have a lot of cash, but these are tools that people can use to get into a home. And I think that's the big push right now is, look, we don't want people to necessarily pay 50 years on a property, but rather use it as a tool to get some movement going and help them build wealth, because real estate, bar none, is the number one way you can build wealth as a family, as an individual.
When I don't think that and I agree with that 100%. I don't think when the president put this idea out there that it was, I'm coming up with a new loan program that might help somebody. It's a solution for affordable housing. And this is a tool that people can use to do all the things that we've just said. But one of the biggest problems with affordable housing is not the monthly payment, which this will help. It's the down payment requirements that we have in all of these loan programs. So if it's 3.5%, 5%, government-backed loans, it's up to 20%. That is where the unaffordability comes in. Because if you have, what's the number we've been using? 300,000?
300,000.
That's $9,000 to $11,000 down that you have to put down. That's required to get the loan. Then you have closing costs on top of that. Then you have all the other fees for title, for all the services vendors that are helping you. There's so much money required to get into these deals. That should be the side that we're looking at for affordability.
Now, I don't disagree, but the opposite argument would be, well, they don't have any skin in the game. Well, what do you say to that?
If it's affordability that we're worried about and getting people into the ability to have wealth, then we are so debt heavy right now, credit card debt in this country. I think it's, a stat I heard was it was the most since the Great Depression or something like that.
I believe it. Yeah.
Then there's no cash on hand. But you're talking about skin in the game. They lose the house if that's the skin in the game. They no longer have that asset. It's just like anything else. If you can't pay, you lose the asset. That's their skin in the game. They've moved into the home. Because once I pay 20% down, I don't have skin in the game. I have equity in the house.
Yeah.
If I don't pay, that equity's gone anyway because the house is gone.
Sure.
So where does skin in the game come in?
Well, in 2008, when the big crash happened, the first go around, if you looked at the default rates, actually one of the lowest default rates were the 0 down loans on the VA side. They actually had some of the lowest default rates. And that was the big argument. Well, they didn't put any money into it. Well, no, it wasn't just that. That was one of the things, but there was all kinds of other factors that contributed to that market crash. But I don't think there's necessarily a correlation to the amount of money you put down in the default rate, the way we're talking about it here for an affordability, for someone getting into a property. Now, it's a little bit easier to walk away from, sure, but you're also walking away with it from an asset that you've paid on for 3 or 4 years that you don't want to lose the equity that maybe you've built up, even if it was a 0 down loan. So I don't know if you can draw that direct correlation, but so I agree with you in that.
Well, I think that the default thing, that's an interesting statistic, but I don't think that if we're talking about affordable housing, everybody, if we keep the same parameters, the same requirements for down payments, the same costs for construction, the same, interest rates that we have right now, who has to suffer to make affordable housing? Right?
The builder,
somebody's got to suffer.
Seller,
somebody's got to suffer to get affordable housing. So if affordable housing is the goal, is getting more people into doing exactly what you were saying, Shannon, to have an asset that will appreciate, that you'll gain equity in, that you can actually borrow against, all of those things. If we want more people to get in there, take away a lot of the barriers for entry. So that's the down payment requirement. Mm-hmm. It's not the monthly.
Interesting.
The 50-year loan still has a down payment requirement.
Yeah.
Mm-hmm. But then that only solves the monthly payment.
Yeah.
So that's a wage thing. But if we don't have cash on hand, which most people in the country do not have cash on hand right now, that's the barrier to entry.
I think another important thing to consider is, we're also not advocating for people to get massive amounts of debt. That's not the goal, is to get massive amounts of debt. I think this follows through with whatever you're going to do. You talk about student loans, whether it's student loans, whether, whatever, having credit cards, anything that you do, the whole idea of having that leverage to be able to borrow money, get an education, and for a while you just pay a little bit because you're building up, but eventually that paid off tenfold because now you do very well and you've got that knowledge and you've paid it off and you're going on. It's the same thing with the house. You may just be kind of scraping at the first, but the idea is the long game. And it should be the same with credit cards. It should be the same with everything. When I borrow money, it's not because I want to, just go buy some stuff, we very, very rarely borrow money. We try to save, and I know that, and I'm not saying everybody can do that, and I can't even always do that. I do have to borrow money at times, so I'm not saying that. But the idea is, is to have assets in place where you can live on them. If people just are taking that, this is one of the big problems we had in the last crash, is that people would take their low, they bought a house and they didn't put a lot into it, and then they would refinance their equity out and then refinance their equity out and refinance their equity out, and they kept doing that because interest rates were low and they could keep pulling it out, and they're buying boats and they're buying razors and they're doing whatever they want to in their life, and then the market goes downhill. They can no longer sell it for everything they've pulled out of it. They have spent every penny of their equity. And that's what people don't realize. People will say, well, I didn't make anything on my house. You took thousands of dollars out over years and years and years, and you didn't make good choices with it. I think when it comes down to it, the idea is start building equity, start building wealth, and do something good with it. Like with your student loans, there's nothing wrong with taking out a student loan, but be smart about it. Don't take out a $200,000 worth of loans for a job that's going to pay $50,000 a year. That's not a wise investment. Don't get a 50-year mortgage and sit on it for 50 years. That's not a wise investment. So the idea is to leverage these ways of borrowing, even if they're not optimal. You're not always going to have optimal circumstance. I'm not always going to have, a low payment, 2% interest for whatever amount that I want. You're not going to have that. But the idea is to take it and use it to gain the wealth, and use that wealth that you gain wisely, hopefully, to gain more wealth, and not just to be throwing it around and saddling yourself.
Yeah.
So when people think they're saddling themselves with all this debt, you could be.
Yeah.
Or you may be building your best investment you've ever had. It's really up to you. How are you going to use that tool? The tool is not bad.
Yeah, being strategic about your plan and your vision for your life is important. It's a key component. We had a lot of peers that came out immediately with the 50-year mortgage and like, this is terrible. This is debt,
horrible. Yep.
Debt service that people will never be able to pay off. This is indentured slavery. And they didn't think about it like this, like how I think about it. I would 100% use a 50-year mortgage. You know why? Because I would buy an investment property. My payment would be lower and I would pay on it like it was a 15. But if I got into a pinch, something happened, then I could default back. I could slide for a couple of months.
That's right.
And have a lower payment. But in the meantime, I would pay on it as if it were a 15-year mortgage until that point.
Huge strides
Big
with every
strides.
extra payment that you make.
Yep. So those things factor in. This is absolutely a tool that can be used. And I think it will help with the movement in the overall market if it's done right. That's the big thing right now. In real estate, you have to have movement. There needs to be movement. And there's so many homeowners out there, which we don't blame. They're sitting on, I'm one of them, sitting on my 2.75% interest rate or 3% interest rate.
Why would you move?
Why in the world would I sell and lose that interest rate if I weren't advancing myself in other ways? Having said that, we have just about another 7 or 8 minutes here. Want to talk about the potential for portable mortgages. And for our audience, a portable mortgage, they actually do this in Canada, which is pretty wild. I didn't realize this. But up in Canada, let's say you have a 3% mortgage, you bought a $300,000 home, you've paid down $100,000, so you have $200,000 left on your mortgage. You can take that 3% $200,000 balance and move it to another property, buy up. Let's say you buy a $500,000 property at that point, $200,000 of that will be at the 3%, and then you get the prevailing interest rate for the remaining amount.
I have a question.
Pretty wild situation that can happen up there.
What happens to the first house?
Well, you have to have enough to realize to pay for that. You're going to have enough. I mean, you're going to have it would be no different than if you paid off that mortgage and you went and got another $200,000 mortgage over here, but you can use that same mortgage. So you still have to get enough out of there to pay that off.
So you're selling the first house, paying that off, keeping what you had as the remainder. So rate and balance and move it to a new property.
Yes. And I think in some instances they do a blended mortgage. So they'll blend the interest rates. And you have to be able to port that mortgage. And
so you might have $200,000 that you had at the 3%, and then you have to get the balance of it at a current rate. I don't think
lenders even understand it.
Yeah.
I don't know many lenders that could understand this.
It's pretty wild. It's pretty wild.
How does that get paid down?
And you're still gonna it's the same exact mortgage. Think about
this.
A
payment, and then they say, this amount goes to this, and that gets amortized the right way, and then this amount goes to that, amortized the new way.
It would be like having a first and a second. It would be having a first and a second, basically. Yeah,
it's pretty wild. Yeah,
and the house would still have to qualify. The lender could still say that. The lender could still say, could still just determine they want to make sure they want to move it to that property. Yeah. So there's some.
It's kind of like an assumable loan. Like you have to qualify for an assumable loan. The loan has to be set up as an assumable.
Only difference is the loan would stay with the house with an assumable. The loan would stay with the actual person that took out the mortgage, so that it would stay with you. It's
a wild concept, and honestly, Paul, I see how you're looking, and those cogs and those wheels are turning. That's what I did too, and I still don't know if I have it fully figured out how they maneuver that. But those are kind of next level thoughts, like how do they actually blend that, or how do they release it from one asset and move it to the next with a full payoff?
How would you refinance? Would you refinance both to a new? Current.
Exactly. So I mean, there's those types of questions, but the premise is that you can move your current interest rate to a new asset. And that has been done and is being done today in Canada. Is that an option for the United States? Yes. I mean, the president's floated that. The administration's floated that as an option.
Is that just residential?
Good question. Because we're coming up on a debt wall they call it a debt wall in the commercial field right now, where a lot of commercial properties are facing rising interest rates. When they bought back, when the interest rates were 3 and 3.5%, 4%, those balloons are coming due now. And so we're going to see a lot of commercial movement, and I think a lot of foreclosures in the commercial arena, but we're going to see how that plays out. That's a whole nother topic we can get to. But what do you think, Shannon? Should portable mortgages be an option or something we consider here in America?
I think all of it should be options. I don't think that everything's right for everybody, but I think all of it should be options. I think every tool that we have available to people can be an asset if used properly. If you use it properly and the right people are using it, it's not going to be for everybody. I absolutely think the more tools they give us, the better we are.
And that's how you, and that's
because the ultimate goal is for Americans, for us to be buying real estate and growing wealth. That's the ultimate goal. And so any tools they can give us, I think don't hurt.
And that's what you feel about the 50-year and also the portable, because you had made the point before is like there's 3-in-1 arms, 5-in-1 arms, where people are like,
I was just going to sound smart and bring those up.
Yeah.
Dang it.
Paul, let me rewind that track. Go ahead. And what else? What other
What
tools
else is there, Paul?
Yeah.
No, you already said it.
What other options do we have?
Yeah.
I hear you got some ideas.
But the problem with that too, the 3-2-1, you got to buy that down. So you have upfront cost again. The biggest,
I can tell you, I took out an arm years ago to buy an investment property. I paid $0 down. It was a 3-year arm. I walked in with nothing. I financed all my closing fees and everything into it. It raised it just a little bit, turned around, sold it. I want to say 2 years later. I think I made $25,000 off it. This was a little place in Aztec. And back then that was a huge growth. It was a great move. It cost me nothing. And the first thing I did after I bought it was put a renter in there that paid that mortgage the entire 2 years. All I did was fix an air conditioner and a couple of things around there for those 2 years, sold it and had that money. That's why I'm saying if used right, they're very valuable.
Well, the arms aren't typically done much anymore.
No.
I was thinking more of the buy downs, the 3-2-1 buy downs, where you have, deferred interest for the first year. It goes up a little bit,
The idea would be that your income grows.
Yeah. So your income grows and then you're able to either refinance before it hits to the current mortgage, same thing as an ARM. So you're not paying as much, but currently everything that you have to get into without a strict down payment assistance program, which is hard to get into because you have to be, meet certain income criterias. You still have these huge payments at the outset of purchasing a home. I think that's the biggest barrier to affordability.
The affordability factor is pretty key.
Because all these tools are great if you can afford them.
Yeah.
Right.
Yeah.
Right.
But you got to buy them first. That's the problem.
And you have to use it properly. Because if not, you're just throwing your money away and you're setting yourself up for, a foreclosure and never buying anything for years or being saddled with debt forever.
If you are silly enough to go the full 50 years, you probably deserve it.
And I hope I'm not around to shake your hand at the end of the 50 years.
Man, that was a good 50 years.
That was a good 50 years.
I saved $200 every month.
That's right.
paid in this instance
$700,000
$765,000 in interest on $240,000. I mean, literally, it's like almost like a credit card. I mean, if you racked it up and just paid like almost the minimum balance.
And that's what I'm saying. But a credit card can be very valuable in a pinch. If the credit card, if used for an emergency or used to advance you, I have a good deal here. I'm going to do this and I can pay it back. I have a plan for a 2-month plan or whatever. Just like a student loan, all of it is a good idea if used right.
Yeah.
All of it. None of them are bad tools. We just have a society that doesn't know how to manage their money. Not saying I do, just doesn't know how to manage their money properly and explodes in debt. And then they just want out of the debt.
Yeah.
That's not how to do it.
And that's the great argument for getting with the professionals that either know how to get you into these programs, get you out of these programs, or how to use them to the maximum benefit in your situation.
Because these things are complicated. I mean, you can look at a lot of different scenarios before making a decision. You want to make the right decision. So you need to seek professional guidance. You need to ask these questions. You need to rely on people that are doing this every day, day in and day out. I would never walk into my accountant and say, "Hey, those I understand what you're doing here. And these numbers, can you explain these numbers? I would never say, you need to move those numbers over here and these numbers over there.
Yeah, I want to do it like that.
Yeah, please tell me what your thoughts are and
tell
what
me
rationale.
how to do it.
Yeah.
You're the expert.
And then I can pick from there, and we can make some good decisions. So great conversation. It's winding down. I do want to let our audience know we do have a customer appreciation event coming up December 13th at Allen 10 Theaters, and you get a pick between one of two movies, Zootopia and Wicked 2, which is going to be awesome. So if you are a current client or a past client of the Lyons Group and you're watching this, go to our Facebook page, let one of us know that you'd like to come. You're welcome to bring your entire family. In fact, we would love to see that. It's a free movie for our guests, for our clients, and your family. And so please sign up, RSVP, because hopefully we'll have we had an awesome turnout last year.
It's super
so
fun.
So fun.
Yeah.
So yes, contact one of the members here at the Lyons Group. And of course, schedule a consultation with anyone here at the Lyons Group. We'd love to sit down with you and give you an advantage in today's market, whether you're buying or selling, commercial or residential. We can really give you an advantage in today's market. So thank you for listening to this episode of The Den. Until next time, we'll see you then.
Thank you for listening to this episode of The Den, powered by the Lyons Group. Hit the subscribe button to keep informed and check the show notes below for direct links to our buyer and seller video series. The buyer and seller video series can give you an inside track on taking the right steps in real estate. If you'd like to learn more about the Lyons Group or to schedule a consultation, go to sjcbroker.com. Complex markets require complex strategies. The Lyons Group can give you a true advantage in any market. Whether you're buying or selling, residential or commercial, contact us directly at sjcbroker.com. We're time-tested experts with a client-first approach, and we'll see you next time in the Den.